The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we near the end of the month of November, Thanksgiving holiday in front of us, Christmas time as well, right around the corner, and we take a look at harvest, pretty much wrapped up here. Fall field work, some of that ongoing, but largely we're putting the closing the book on 2024's growing season. Watching these markets, there's been plenty of interesting news dynamics that have driven the grain trade here this past week. Livestock, looking at some interesting moves there as well. Maybe a little more optimism in cattle and hogs. Let's talk about things, talk about the overall ag economy as well. Joining us for a conversation here today on the show, Chad Hart with Iowa State University is with us. And Chad, it is great to talk with you again, sir. How are you?
It's a pleasure to be with you, Jesse. I'm doing fine.
Well, let's just start and a good 1,000-foot view here. We've seen a lot of folks concerned about the overall ag economy, and although maybe there's been a little more optimism from some folks out there, it just feels like still there's a lot of concern about depressed prices and looking at the books going into next year and more. So what's your take on, nearing the end of November, the overall state of just this ag economy? What are you seeing, Chad?
Well, that's the deal. We know we've definitely taken a step or two back when it comes to the overall ag economy. I think the challenges are different depending upon where you're looking within the economy. As we're looking at our crops, it's the case of, as you mentioned, sort of, great supplies, overwhelming supplies that have overridden demand, driving our prices downward. On the flip side of that, when you look at the livestock industry, they're dealing with plentiful feed, which is helping reduce some costs, but they're still seeing their other costs, especially in this case, replacement animal costs, continuing to ratchet up. Even though prices are good and strong, costs are still as well. And so we're feeling the squeeze for both crops and livestock at the same time. And I think that leads to let's call it the general concerns that we have with the ag economy. Now, the question is, where can we try to start building up from here? And I think the encouraging things here, as you mentioned that, as we look at the livestock side, for example, the idea is that we continue to see those prices remain fairly strong. Consumer demand is hanging in there with us. And hey, that helps us pull through these higher cost times. On the crop side, what we've been seeing is some increases, especially in international demand, that hopefully we can continue to build upon so that we can work through these supplies and try to get to some better prices down the road.
Let's lean in here, commodity by commodity. Let's start in the grains, quartered soybeans. Let's take a look at the row crops here. Different dynamics, I would say, for the two. On the corn side, it's felt like the market hasn't really moved a whole lot here lately. It's kind of been stuck in this 420, 430 range in lead month futures. You look at the spreads, basis, things of that nature between quartered soybeans. I mean, those have tightened up here post-harvest as well. What are you watching dynamics, looking at row crops? Start with corn first, Chad.
Well, that's the deal with corn. If you think back to right before harvest, we were down in the high threes. As you say, now we're holding in this 420 to 430 range. So we've been able to build up about 30, 40 cents worth in the marketplace and hang on to it. And so here, and I'm going to argue a lot of that buildup has been because we've seen export sales approaching record levels. I mean, they're not quite as strong as we saw in 2020, but they're not that far behind. And so that's helping create a pathway where we could see usage building up enough that maybe stocks, aren't going to build up quite as quickly as we had hoped, and that therefore give us a little price relief there. And when you look at those export sales, the beauty of them is they're almost up across the board. It doesn't matter whether I'm looking at Latin America, Southeast Asia, heck, even into Europe. We're seeing additional corn sales this year compared to last year.
I'll weave in soybeans here. You mentioned export sales. We've seen good soybean demand, but of course, the worry of new tariffs from the Trump administration. Plus, we saw Brazil and China sign some 37 agreements this past Wednesday, strengthening their relationship between the two countries for many products, et cetera. So when you look at soybeans, a lot of folks have been way more bearish this bean market right now for some of those factors. Would you agree?
I would agree. And yeah, it basically comes back to China. When you think about our export markets with soybeans, we've been seeing similar growth to what we've been seeing in corn, with that one big exception being the Chinese market. And as you mentioned, the idea of the double threat of additional tariffs coming down the line, with China being a major target for that, along with the Chinese partnership building with Brazil, it does lead to some definitely negative connotations as we look forward in the soybean market. The challenge is really trying to figure out, how do we build something beyond China to help replace some of those losses. And like I say, we've seen some export sales pick up, but that's where the conversion, the increased crushing capacity here within the U.S. is seen as sort of the, let's call it, the major backstop to helping support demand as we move forward in the soybean complex.
I'll throw this to you for your thoughts here. And I wonder, we can't outguess the market. There is, of course, the potential that soybeans could go lower if we do end up seeing those tariffs, potentially new tariffs, things like that. I just wonder, though, with some of the export business we're seeing, et cetera, that's one thing. But is the market maybe already trying to buy corn acres for next year versus soybeans just because of some of the unexpected unknowns that are out there right now for soybeans? What do you think, Chad?
Well, I would argue that the market has already done that. And in fact, when you look at USDA last month, they put out their long-term projections. And this is where we got our first look at what they thought we might see in 2025. And they were showing growth in corn acreage, reduction in soybean area, just exactly like you're talking about here, even though prices for both commodities are projected to go lower. So it's saying, okay, out of the two, we see problems for both. But, USDA's estimation is that farmers will be moving towards corn as the safer option as we look forward in 2025.
So, thinking from a risk management standpoint, obviously a lot of farmers still have plenty of this year's crop that they need to market and sell. Mainly corn. I mean, there's some beans out there too, but looking at different tools and strategies and re-ownership, et cetera. But should they not, should they be looking at not only marketing the current crop, but even looking out to some of the 2025 prices that are out there right now, just with some of this uncertainty and some of those USDA estimates you alluded to?
Well, I wouldn't necessarily be that aggressive on 2025 yet. I mean, if you're thinking about the timing of what we're looking at here, for the 2025 crop, we've still got plenty of time with which to allow the market to develop and form. And I'm a big believer in utilizing the seasonal patterns that we tend to see as a guide as we move forward here. And so we're just now emerging out of harvest. This tends to be a lower price time within the year seasonally. And so I would rather wait until we get into the springtime, see if we see that natural buildup in prices that we usually get, and then take advantage of that for 2025. But it's always the case that I think farmers should be always thinking forward, what is the price level I need to capture to keep myself in the game as we look, especially in tight financial times, and have those markers in with those, with the co-ops, the feed mills, the ethanol plants, so that, if we do see a surprise that hits very quickly, you can take advantage of those opportunities.
That's a great point because it is it's meeting season, it's seed decision season for a lot of folks. Looking at their cost of inputs, fertilizer, seed, chem, etc., thinking about next year already. On top of that, though, I would say if you can stay flexible as you make some of these decisions, potentially, that might be a good way to go, right, Chad?
Well, sure. It's always helpful. And if you think about the tools that we have available to us through futures and options, they're built to keep that flexibility for you, and that you're not locked into a specific location you're selling to. Heck, you're not even locked into necessarily making that sale at that time. You have the flexibility to change over time. And so, yeah, especially this early when we're thinking about the 2025 crops, I want to maintain as much flexibility as possible.
Chad Hart with Iowa State University is our guest analyst here today on Market Talk. Chad, let's bring in the wheat markets. And the other big news item we've really seen the last week plus has been the escalation in tensions in the Russia Ukraine war, having an impact there. Although we have not been screaming higher in the wheat markets, we put in a little bit of war premium here and there and then kind of settling it out. It looked like on Friday's trade, but just your thoughts, wheat, the global picture here, the escalation of tensions. Just feels like the market, we talked about this before, it feels like the markets have become numb to this, barring some escalation that is far greater than what we've seen. Right, Chad?
Well, I think you've got that. Plus, you've got, I mean, it's feeling some of the pressures that we talked about with corn and soybean markets. As you mentioned, we built in a little bit of a war premium here, but that war premium is sort of dependent upon us picking up additional export sales as we look forward. Yet the tariffs may push against that. And so I think that's what is sort of leaving the market here, where we're taking 2 steps forward and 2 steps back. The idea is for every positive piece of news we get out there, we can find a negative one to offset it.
Well, I wonder about this too. The dollar has been super high, and obviously, to your point, that's been having an impact on all commodities and trade and more. And just thinking about the dollar, rolling that into all of this here, your thoughts there, dollar inflation. I mean, what are some things we need to be keeping our eyes on in that respect here as we near the end of the year?
Well, that's the deal. With the dollar being as strong as it is, normally I would have expected to see, let's call it less positive news coming out of the export markets. If anything, we've sort of fought through the strength of the dollar. As you look at export sales year over year, for the most part, they're up on the crop side. So that says even with the challenges of the dollar, we've been able to regain at least a little market share. But the longer the dollar stays stronger, and the, let's call it, as the likelihood of tariffs coming in increases, the idea is those downward pressures are definitely building. And I think, it's definitely what has been holding the soybean market down. And that, let's call it, those thoughts are starting to creep into the wheat and corn markets as well.
I wonder with the incoming Trump administration, how could that change things in terms of economic policy, inflation, interest rates, et cetera? I think there's some questions there as well of what this could all look like as we get into 2025, Chad.
Oh, it definitely brings it up. As far as there's going to have to be changes across the board to sort of work in, if these tariffs do come to pass. And the biggest question really is how do other countries respond if we put those tariffs in place? I think most economists like me, we do expect most countries to respond with retaliatory tariffs of roughly the same size, but they may not. And if they don't, that sort of changes the dynamics of how those tariffs work and who ends up, how I'll frame it this way, how the impacts are spread across the globe.
Mm-hmm. No, that's a good way to frame that up for sure. Chad, I wonder as well, let's talk South American weather too. That's going to play a big role in our markets moving forward. And it's really that season now where we watch weather in Brazil and Argentina. Things have been pretty favorable there. I'd say, if anything, the next big milestone is going to be soybean harvest. And if it's potentially delayed, does that delay safrinha corn planting, things of that nature? That seems to be the big thing in terms of what we're watching out of South America, in my mind. Would you agree?
I would agree, and especially as you say, it's watching that soybean crop down there. For the past several months, as you looked at USDA's projection for Brazilian soybeans, they've been at 169 million metric tons, which is an incredibly large crop, a record crop for Brazil, and nearly 50% larger than what we just brought in. So just the thought of that crop getting planted on time, seeing some favorable weather there, that's definitely another big anchor that's weighing on the soybean market right now. And so it's this, let's call it this counterbalancing effect right now that we're trying to figure out here. Will we get enough exports before that crop comes in and before the tariffs come in? That's the big race here that you're looking at the soybean side for. And what's been encouraging, for example, this morning, We saw USDA announce another sale. It's to unknown destinations, but a really good sized soybean sale for this year's crop.
Well, of course, when prices are down at the levels they are in soybeans, we hope that would spur on some sort of buying interest to at least give us some support in the bean market, no doubt. Let's go over to the livestock sector. We alluded to it a little bit earlier. Things have been better there. Cattle as well. Feeder cattle have been the leaders this week. There's been plenty of activity in cash as well here in the last several days. There's maybe been a little disconnect between cash and futures, I would say. I mean, what are you watching in this cattle market right now, Chad?
Well, we're definitely, as you say, feeders are sort of leading the charge. We are trying to figure out when does the industry start to try to rebuild. Again, key number will come out later today as we look at the cattle on feed report, but the expectations are that we continue to see us pulling cattle into the feedlots as quickly as we possibly can. In fact, that came out of yesterday's livestock slaughter. When you look there, beef production year over year up basically 5%. And it wasn't because we necessarily moved more animals through, it's because those animals added some additional weight to help create the beef that we see. And so I think that's the dynamic here. We're trying to figure out when do we start to make the turn to, let's call it, stabilize the number of cattle first, and then see how quickly we might go to rebuild.
I talked about this on yesterday's program. How long can the bulls necessarily keep winning in this cattle market, Chad? We've been at these lofty levels for so long. I think people are getting used to it and maybe not protecting their risk in ways that they should, because all it takes is one event, and we know we've seen it before multiple times. We can quickly chop a lot of premium out of this cattle market, can't we?
Yeah, we definitely can. I would agree. We do need to protect our risk still on the downside. But how long can we keep this up? Well, realistically, as long as consumers are riding along with us. That has been the linchpin to all of this, that as we've watched our cattle and beef prices march higher, our customers have held in there. And not only is it our domestic customers where we've seen, like I say, resilient demand there, but as you're looking at like the export markets, even though we've been working our way down in terms of total beef production, our export levels have basically maintained at fairly stable levels. That's telling you international consumers are holding strong as well. And so as long as you've got the global consumer base willing to pay those higher prices for beef, the bulls can continue to run.
You're in hog country there in Iowa. This hog market, maybe a little bit of a technical correction early in the week, but then kind of stabilizing, it felt like here. And hogs, too, have been on fire in recent weeks. What's your thoughts over there, Chad?
They have been on fire. It's been kind of interesting to watch. And again, when we looked at the livestock slaughter report yesterday, pork production up 5% year over year, and yet we're seeing these stronger prices. And so it again sort of begs that consumer demand for proteins has remained resilient in the face of higher prices, in the face of inflation. And, while pork, if you will, took a while to capture that, beef and poultry had an easier time through the inflation run. Pork demand has been, let's call it, not quite as strong as the other two meats, but good enough. And we're seeing the same thing again. It's both domestic and international consumers that have continued to want, to buy at these higher price levels.
I wonder about this too, and this could go across the board, but thinking about the proteins and hogs in particular, China's economy, there are a lot of mounting concerns about the health of it. I know the Shanghai Composite Index was down over 3% on a Friday. How much does the worry about China's economy concern you, especially the hog market right now?
It's a concern, but I would say that's one that's been slowly, let's call it, releasing pressure over time. If you're looking at the hog market today, our top customer right now, South Korea, they've shot up to number one. You got Japan in there at number two, I believe, Mexico at number three, and China's now down at number four. So, compared to like 5 years ago when China was by far the biggest market we had there, we've seen these other markets grow in importance as China has diminished, and it's helped rebalance the pork market just a bit. So it is more resilient to those Chinese pressures than it was, say, 5-10 years ago.
Chad, always enjoy a conversation. Great insights. As we close it out, anything final you'd mention or reiterate to folks here on the show today?
Well, like I say, when I'm looking here, it's more this case of, sort of across the board here. I've been talking about how consumers have remained fairly resilient for us. And that's, I'm going to argue, is the key as we're looking forward into 2025. We've got plenty of supplies on hand in most commodities. Cattle and beef may be the one where we're a little short. So it's this case of we've got the supply. It's a matter of, can we continue to grow the demand to match the supplies we've got?
A lot of things to keep an eye on, no doubt. And I'm sure we'll talk to you again in a few weeks as we close out the year. Chad Hart, Iowa State University, thanks for joining us on Market Talk today. Have a happy Thanksgiving. We'll talk to you again soon.
You too, sir. Thank you much.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.